Welcome to The Explainer. Today, we're diving into a massive, honestly, kind of baffling mystery sitting right at the heart of India's financial landscape. We're talking about the curious case of the falling Indian rupee. Look, whether you've been watching the markets, running a cross-border business, or just, trying to plan an international vacation, you've definitely felt this. But the mechanics behind exactly why it's happening right now, they're absolutely fascinating. So, let's unpack this data together.
96.97. In May 2026, the rupee hit this absolute all-time low against the US dollar. I mean, that is a staggering figure, right? It sent total ripples through corporate boardrooms and retail portfolios alike. We're talking about a 12% weakening of the currency in just a single 12-month period. But this number alone doesn't actually give us the whole story. In fact, it leads us to a pretty massive contradiction. Okay, let's dive into this because this is the central paradox we're exploring today. Why is the rupee falling when the Indian economy is booming at an 8% growth rate? According to the data, the economy posted a blistering 8% growth in the first half of the 2025-2026 financial year. And retail inflation? It moderated to an incredibly healthy 2.2%. Normally, robust growth plus low inflation equals a strong, surging currency. Yet, the rupee has essentially become the soft underbelly of emerging market currencies against the dollar. So, why? Well, to understand the present, we've got to look at the past. And the reality is, this drop isn't just some temporary blip. We're looking at a structural, almost mechanical feature of the Indian economy. Just look at this one-way ladder. We went from 17 rupees to the dollar right before the 1991 liberalization, to 46 by the year 2000, 75 in 2020, and now 97? The data shows us the rupee has depreciated against the dollar at a compound annual rate of around 5% for over 3 decades. The Reserve Bank of India steps in to prevent chaotic crashes, sure, but the structural direction, it's basically a one-way ladder going straight up.
So what's actually pushing it up that ladder right now? Well, our sources identify a perfect storm of 7 specific macroeconomic forces driving the drop today. We've got a structurally strong US dollar bolstered by higher for longer rates, heavy foreign equity outflows, and, of course, surging oil prices hovering between 97 and $110 a barrel. Throw in current account deficit pressures, external commercial borrowings, and the RBI's specific volatility smoothing approach, and yeah, you've got heavily loaded dice. Let's zoom in on that rate and inflation dynamic for a second.
Because this is where we see some serious macro dissonance between India and the US. Economic theory tells us that, the country with lower inflation should see its currency appreciate, right? Because it holds its purchasing power better. But look at this. India's inflation dropped below 2.2%, while US inflation hovered around 2.7%. It is super rare, like really fascinating irony, for an emerging market to have lower inflation than an advanced economy. But the dollar still won out. Why? Mostly because the sheer gravitational pull of high US interest rates combined with India's trade deficit, which is heavily driven by importing 88% of its crude oil at high prices, just completely overpowered that inflation advantage.
And then we've got this massive catalyst. 2.2 lakh crore rupees. That is the staggering amount of record outflows from foreign portfolio investors in 2026 alone. Literally the worst outflow year since foreign investing in Indian equities was even permitted back in 1992. The mechanics here are simple, but man, they are brutal. When foreign capital exits the Indian market, it exits in dollars. This sucks the dollar supply right out of the domestic market, demand spikes, and boom, the rupee weakens. It's a direct, undeniable mechanism. Now, alongside foreign investors leaving, we really need to look at how Indian corporations are bringing money in. And that brings us to external commercial borrowings, or ECBs. Basically, this is just funds borrowed by Indian companies from foreign sources in the form of loans, bonds, whatever, to fund expansion or refinance debt. But here's the catch. Borrowing in a foreign currency when your domestic currency is actively falling, that introduces a fascinating and pretty dangerous layer of risk. Just look at how these external commercial borrowings have fluctuated over recent financial years. Data from the PNB Economic Intelligence Cell shows this crazy whiplash in ECB registrations. Back in 2022-2023, borrowings fell by a third to a 5-year low. Why? Because the US Fed was aggressively raising interest rates, making it way more expensive to borrow globally. But then, by the first quarter of 2023-2024, bam, a massive spike back up to over 20 billion USD. Companies were practically forced to look overseas again as domestic banking liquidity tightened up and the RBI increased risk weightages on domestic bank credit. But relying on these overseas funds is a total double-edged sword. Actually, it's a huge hidden danger. especially for one specific sector, non-banking financial companies, or NBFCs. They're definitely at risk here. They make up roughly a third of all ECB registrations, but the trap is in their loan maturity profile. The average maturity for an NBFC's foreign borrowing is just 4.68 years. Compare that to almost 7 years for the overall corporate average. Because their borrowing windows are so much shorter, NBFCs are uniquely and persistently exposed to exchange rate volatility. A strengthening dollar directly hits their ability to finance their debt, basically forcing them to borrow even more just to refinance and stay afloat. So, with all these intense pressures, what is the central bank actually doing? Well, the RBI is making defensive moves, but they're highly strategic. They've sold $33.6 billion net since April 2025 to support the rupee, and they executed 4.2 lakh crore in open market operations to manage domestic liquidity. They're basically using their massive reserve buffer, which they're maintaining in the $640 to $700 billion band, to keep things steady. The data makes it super clear. The RBI is not trying to artificially peg the rupee to a specific number. They just want an orderly market. They're letting the currency find its natural level, just, without the chaotic daily swings. Now, this massive macro shift isn't bad news for everybody. It actually drives a massive transfer of value depending entirely on your industry. Let's look at the sector winners and losers. If you're in IT services or cross-border SaaS where you're billing in dollars, you are a huge winner. Your USD receipts lift your INR revenues. But if you're in electronics, consumer durables, or airlines, yeah, it's heavily negative. Your input costs like imported components, aviation fuel, equipment leases, they're all priced in an increasingly expensive dollar, which just absolutely crushes your margins. Meanwhile, e-commerce and auto OEMs sit somewhere in the middle with mixed results.
So how do businesses actually survive or even thrive in this kind of environment? Based on data from Nirji Ventures, CFOs and founders need a strict operating playbook. Step 1, implement a rolling, rules-based hedge program. Stop trying to guess the market. Work with your banking partners to stabilize those cash margins. Step 2, reprice with precision using FX pass-through bands. You gotta move away from once-a-year pricing. And Step 3, redesign your supply chains to dual-source inputs. Try to mix in suppliers who price in local currencies so you can dilute that dollar exposure.
Furthermore, you've got to carefully stage your foreign currency capex and strengthen your working capital buffers. Seriously, if you're buying heavy machinery or software from abroad, align your currency hedges precisely with your payment milestones. Do not, I repeat, do not leave a massive 50% final payment unhedged and exposed to a single-date foreign exchange shock. That is a quick, painful way to watch your margins just vanish overnight. And tightening up how fast your overseas clients pay you, absolutely critical to surviving this kind of volatility.
But hey, what about retail investors? How do you and I protect our wealth from this 5% annual erosion? Well, the strategic response, backed by analysis from the Economic Times, points directly to a defensive portfolio allocation. We're talking about dedicating 25% of your portfolio to U.S. equities, using routes like the liberalized remittance scheme, while keeping the remaining 75% in domestic Indian assets. This isn't just about chasing different tech companies, it's a structural hedge against a structural reality.
There's this quote from the Economic Times that perfectly captures the whole shebang. A portfolio with dollar exposure absorbs the equity impact but earns on the currency move. Think about it. If you hold a U.S. asset, you're earning on two levels. First, whatever the asset itself returns, and second, you get the built-in tailwind of rupee depreciation. Even if that U.S. stock stays completely flat for a decade, the historical 3 to 5% annual currency depreciation means the rupee value of that asset is still growing significantly. It's an incredibly powerful, double-layered return mechanism that a domestic-only portfolio just can't give you. Which brings us to the ultimate question you really have to ask yourself after looking at all this data. Is your business or your personal investment portfolio truly insulated against the next 5% rupee drop? The historical data, the macro forces, the structural realities, they all point to a currency that behaves dynamically, constantly reshaping the winners and losers. Understanding this isn't just academic theory, it's literally the key to protecting your margins and growing your wealth. Thank you so much for joining me on this explainer. Until next time, keep looking closely at the data.